Imagine this. A good friend calls and says it'd be fun to do a tour of California later this month. She says if we just get there by noon next Friday, we could make it to this most popular music festival where all of our favorite bands will be playing. And you say yes, emphatically, yes, we've got to do it. You pack up your stuff, you grab your guitar, and you head out on the open road. You're feeling great. You're filling the car with laughter and song. Oh, but then you hit Atlanta. You hit a massive traffic jam, you start panicking. You haven't moved an inch in 2 hours, you think you'll never make it at the rate you're going, you start overestimating how long it's going to take based on this current setback. You're ready to reverse course, since missing out on the music fest would make the entire experience a total waste of time. That early traffic jam is like volatility in the markets. It's easy to focus on what's fresh in your mind. But if your focus solely remains there, it can paralyze your thinking and hinder your ability to achieve your goals. If you focus instead on when you need to get there, your timeline, and how fast you can reasonably drive, typical long-term returns, you can navigate your journey with better confidence and a better chance for achieving your goal. This goes right at the heart of what is real risk. So let's dive into it further. Some investors may evaluate risk based on how much the price of their investment bounces around, volatility. Others may define risk more in terms of their goals. What are the chances I won't have enough money to fund one of my financial priorities? For example, a down payment on a home in 2 years, or my child's college education in 6 years, or retirement in 10 years. Both measurements are helpful, but we believe it's better to view risk through the lens of your goals. Why? Well, in the short term, price movements can seem random, based on a million different factors that constantly change. They could include perceptions about a company's prospects, that of its industry, or where it's located. Each investment is then judged and compared against all other investments. But unlike natural sciences like weather forecasting, investing is a social science. The same exact conditions can yield completely different results. It all depends on the mood of the millions of other investors. So if the weather was like investing, it might rain when it's 20 degrees out and then snow when it's 50. The only way you would know definitively would be to get inside each and every investor's head and then stay there, and good luck with that. Even if you could, you probably would need to take up permanent residency inside a shrink's office. Investing legend Warren Buffett once said, the stock market in the short term more closely resembles a voting machine, where each purchase and each sale is a vote on the prospects of an investment. But over time, it becomes a weighing machine that gives more weight to companies that earn more. That's why it can be misleading to measure an investment's risk based purely on how much its price bounces around. It may not accurately account for how well a company is growing its earnings, but more so simply the current mood of the market. So we believe investors would be better served focusing instead on the weightiness of an investment, its earnings and the growth of those earnings, and the timeline for their own personal goals. These two factors will help better determine your asset mix. How much money you should put into stocks, how much should go into bonds, how much should remain in cash. Want a clear picture of your personal investment journey so you won't consider reversing course before reaching that amazingly awesome music festival out in Cali? Reach out.